Welcome everyone to UMC's 2025 second quarter earnings conference call. All lines have been placed on mute to prevent background noise. After the presentation, there will be a question and answer session. Please follow the instructions given at the time if you would like to ask the question. And for your information, this conference call is now being broadcasted live over the internet. Webcast replay will be available within 2 hours after the conference is finished. Please visit our website www.umc.com under the Investor Relations Investors Events section. Now, I would like to introduce Mr. Michael Lin, Head of Investor Relations at UMC. Mr. Lin, please begin.
Thank you and welcome to UMC's conference call for the second quarter of 2025. I'm joined by Mr. Jason Wang, President of UMC, and Mr. Qidong Liu, the CFO of UMC. In a moment, we will hear our CFO present the second quarter financial results, followed by our President's key message to address UMC's focus and third quarter 2025 guidance. Once our President and CFO complete their remarks, there will be a Q&A section. UMC's quarterly financial reports are available at our website, www.umc.com, under the Investors Financials section. During this conference, we may make forward-looking statements based on management's current expectations and beliefs. These forward-looking statements are subject to a number of risks and uncertainties that could cause actual results to differ materially, including the risks that may be beyond the company's control. For a more detailed description of these risks and uncertainties, please refer to our recent and subsequent filings with the SEC and the ROC security authorities. During this conference, you may view our financial presentation material, which is being broadcast live through the internet. Now, I would like to introduce UMC's CFO, Mr. Qidong Liu, to discuss UMC's second quarter 2025 financial results.
Thank you, Michael. I'd like to go through the 2Q25 investor conference presentation material, which can be downloaded or viewed in real time from our website. Starting on page 4, second quarter of 2025, consolidated revenue was 58.8 billion NT dollars, with a gross margin at around 28.7%. The net income attributable to the stockholder of the parent was 8.9 billion NT, and earnings per ordinary shares were 0.71 NT dollars. Wafer shipment in quarter 2 increased to 957,000, up about 6.3% quarter-over-quarter. However, the effective NT dollar exchange rate also appreciated similar magnitude from 30.81 in Q1, from 32.89 in Q1 to 30.81 in Q2. And utilization rate increased from 59% in Q1 to 76% in quarter 2. Revenue as a result increased about 1.6% sequentially to 58.75 billion NT dollars. Gross margin, as we mentioned earlier, reached 28.7% or 16.8 billion NT. This is already be factoring in around 3% of the Forex impact, 3 percentage points in quarter 2. Net income reached 8.8 billion NT or 15.1% net income percentage rate. EPS is 0.71 NT dollar in second quarter compared to 0.62 in the previous quarter. On page 6, for first half comparison, revenue increased by 4.7% to 116 billion NT. Gross margin reached 27.7% compared to 33.1% in the same period of 2024. Net income attributable to the shareholder of the parent for first half of 2025 was 15.67 billion NT, or 1.34 in EPS terms. Cash remained over 100 billion, reached about 111 billion NT at the end of first half of 2025. And total equity for the company is now around 337.04 billion NT. ASP edged up a little bit in the second quarter, mainly due to the better product mix. On page 9, for revenue breakdown, there's literally no change on a sequential comparison basis. Europe increased to 8%, and Asia reached about 67%. IDM edged up slightly to 19% compared to 18% in the previous quarter. In terms of application breakdown, the change is also very minor. Consumer went down to 33% by 1%, and communication increased by 1% to 41%. Advanced technology revenue continues to increase, and with now revenue below 40 nanometer represent more than half of the total revenue, reach 55% in quarter 2, when 22 and 28 nanometer represent 40% of the company's total revenue. On page 13, the capacity breakdown, we will continue to see some minor capacity increase. For the third quarter, capacity increase will come from mainly 12X in Xiamen. And after the first 6 months, our CapEx budget for year 2025 remain unchanged at an estimate of $1.8 billion. And the above is the summary of UMC results for second quarter 2025. More details are available in the report, which has been posted on our website. I will now turn the call over to President of UMC, Mr. Jason Wang.
Thank you, Chi-Tung. Good evening, everyone. Here I would like to share UMC's second quarter results. In the second quarter, the utilization rate increased to 76%, as the wafer shipment grew 6.2% quarter-over-quarter, primarily driven by communications in image signal processors, NAND controllers, Wi-Fi, and LCD controllers. While we experienced an increase in the overall utilization and the growth of our 22 and 28 nanometer portfolio, the unfavorable foreign exchange movement of the NT dollar kept our gross margin to 28.7% by nearly 3 percentage points. Revenue from our 22 and 28 nanometer portfolio continued to grow sequentially, now accounting for 40% of the total sales, a record high in both percentage and absolute dollar terms. Our industry-leading 22 and 28 nanometer solutions continue to win adoption by customers, and we expect to see further market share gain in wireless communications over the coming quarters. We have always believed that with the right differentiation, 22, 28 nanometer is a strong and long-lasting node with a robust product pipeline. In addition, the new Phase 3 facility at our Singapore Fab 12i set to start production in 2026, will enable UMC to better serve customers seeking diversified manufacturing for enhanced supply chain resilience. Looking ahead to the third quarter, we expect a mild increase in wafer shipments. However, adverse foreign exchange movement will lead to a decline in NT dollar revenue. We are closely monitoring the near-term uncertainties and risks as the market anticipates U.S. tariff policies. To navigate macro and geopolitical headwinds, including foreign exchange risks, UMC will continue to actively manage our foreign exchange exposure and maintain financial flexibility to enhance our financial structure and business resilience. Now let's move on to the third quarter 2025 guidance. Our wafer shipment will increase by low single-digit percentage. However, NT dollar denominated revenue is fully exposed to fluctuation in the foreign exchange rate. For instance, a 5% appreciation in the NT dollar will result in a corresponding 5% reduction in reported NT dollar revenue. ASP in the US dollar will remain firm. Q3 gross margin will be approximately Q2 gross margin, subject to the foreign exchange effect. Therefore, our Q3 gross margin will be approximately equal to that of a Q2 under the assumption the foreign exchange rate is at a current level. Capacity utilization rate will be in the mid-70% range. Our 2025 cash-based CapEx budget will remain unchanged at US $1.8 billion. That concludes my comments. Thank you all for your attention. Now we are ready for questions.
Yes, thank you, President Wang. And ladies and gentlemen, we will now begin the question and answer session. If you have a question for any of today's speakers, please press star key and number 1 on your telephone keypad, and you will enter the queue. After you are announced, please ask your question. If you find that your question has been answered before it is your turn to speak, please press star key and number 2 to cancel the question. Thank you. Now please press star 1 on your keypad if you would like to ask the question. Thank you. Now first we'll have Brett Lin, Bank of America, for questions. Go ahead, please.
Hi, thank you for taking my question. So I have two questions. The first one will be on the ASP trend. So what's the initial outlook and view on the ASP trend into 2026, given the higher expense and cost? Obviously, we are happy to learn the steady ASP in near term, but any initial view for 2026? Thank you.
Well, I mean, typically we don't guide anything beyond that. Beyond 2025. So as you said, we can talk about the near term of the ASP outlook, but you'll be interested in looking into a longer term ASP projection. And so let's share about the ASP strategies. We'll continue. Our goal is to continue to differentiate our technology offering and product mix, and to maintain and improve our ASP resilience. We want to further widen the gap in technology offerings while increase the revenue contribution by those respective nodes. Following our rollout of the 22 and 28 nanometer technologies, we'll continue to provide specialty technology in 40 and 55 nanometer nodes, where the percentage of our revenue contribution competing with the pricing foundries will continue to decline. For the near term, our CFO actually mentioned our Q2 ASP saw a low single-digit increase driven by the higher 22 and 28 product mix. And in Q3, we expect the product mix remains unchanged. Therefore, the ASP will remain firm for this year. Yeah.
Got it. Thank you very much. And my second question would be, well, we have seen, in the presentation, 14 nanometer and below mix listed in the, slides as 0 for a while, but still listed in there. So shall we expect the number to increase? And will that be from 12 nanometer or potentially also 6 nanometer?
Well, 12 nanometer is still a bit far for us, and for that particular program, and the cooperation with Intel is progressing well and remain on track according to the project milestone. At present, our both teams are working on verifying silicon performance for the pilot line, and we expect that the earlier PDK will be ready for this first wave custom 2027, so we'll probably see some revenue in that time frame. So I think that's the 12. And we continue, marching that direction. If we're going, beyond that, we don't have any concrete plan for anything beyond the 12 nanometer today. Our development effort will continue to focus on that, and as well to broaden our specialty technology portfolio on both ends. And so that is definitely on our roadmap. But once we have more concrete update, we will be shared with you. Currently, the most important task is to deliver the highly competitive solutions for mass production at 12 nanometer through our close cooperation with our partners. And for anything beyond that, we will explore the future opportunity through the partnership arrangement, and which we believe that will be mutually beneficial.
Sure. Sounds great. Thank you very much.
Thank you. Next one, Charlie Chan, Morgan Stanley. Go ahead, please.
Hi, Jason, Qidong, good afternoon. And my first question is about the tariff impacts your customers' behavior. Do you see kind of pulling in, and what does it impact to your second half seasonality or outlook? Thank you.
Sure. Good afternoon, too. We do observe that some of the demand upside in the Q2 and as well as Q3 is partly driven by the inventory buildup in anticipation of a potential U.S. tariff. And so for UMC's first half 25 results, which is in line with our guidance of the Q2 wafer shipment increase of 6.2 to 3% quarter-over-quarter, while the Q3 demand increase from a higher base, we expect the shipment will still grow mildly sequentially. And so there are some observations about that. Given the 2025 market dynamics, such as adjustment to the U.S. policies and ongoing geopolitical and macro uncertainty, the usual seasonal pattern may be different. We, along with our customer, will closely monitoring those end market signals. Yeah.
I see. Thank you. And I think lots of discussion about the future advanced packaging technology, right? So, Jason, can you share with us about your business development here? And also, I think you have some interposer capacity, right? How are we going to utilize those capacity going forward? And maybe some color about the potential applications.
Sure. Well, I mean, we're not missing. We don't want to miss out the advanced packaging opportunity. We are preparing our advanced packaging solution for what we see is for the growing energy consumption of the cloud AI, as well as the potential growth in the edge AI market. So first, to address the power efficiency requirement for the high computing processor, UMC is developing the 2.5D interposer with the DTC and discrete DTC, which is that's going to be the roadmap coming up. And right now, the current interposer is moving on to the next generation, and we're waiting to introduce this and expect to ramp after that. Second, the UMC is leveraging the scalable 3D wafer-to-wafer stacking and TSV to enhance the competitiveness of our specialty technology. We are currently in mass production of it for the extremely small form factor for the 5G and 6G RFIC. And based on the success of the 5G and the 6G RFIC, with the wafer-to-wafer stacking, we are also developing memory-to-memory stacking and memory-to-logic stacking service for the high bandwidth computation requirements.
Okay, thank you. And my last question, again, is always want to consult you or pick up your brains about the semiconductor cycle, but I believe this is the third consecutive year we don't see so-called second half recoveries. What do you think is happening on this semiconductor industry? Why we don't see seasonality or so-called cyclicality, right? Because I remember in the past you have like upcycle and shortage overcapacity and then correction, but we since don't see that anymore.
I mean, certainly the visibility is actually lower nowadays. You're absolutely right. When we start the year in 2025, we actually expect the 2025 growth outlook will be slightly better than our addressable market, and we think our addressable market is going to grow slightly and at a low single digit. And we think at this moment we still expect our 2025 growth outlook will remain unchanged. So that stays. But beyond the 2025 or 2026, we have to closely working with our customer and sharing their visibility and as well the monitoring the DOI situation. As of today, I think the DOI is getting to the healthy level. We've seen that DOI is approaching to the healthy level about a quarter or 2 quarters ago, and right now the computer, consumer, communication segment is still healthy, remain healthy, and while the automotive and industrial still remain high. So I think while monitoring the macroeconomics as well as the DOI, and then we can only hope that sooner or later we will see the upcycle. But right now the visibility is pretty low. Yeah. Okay. Yeah. So yeah, maybe try again about Brett's question about wafer pricing. So yeah, because obviously FX impact all the Taiwan foundry a lot in terms of gross margin. Would that be a factor you can put on the table to negotiate with your customers for next year's pricing? I mean, we continue working with our customer in terms of pricing conversation, closely. But those are more of a tactical conversation. I think fundamentally, like I recall earlier, I think our key focus is try to differentiate our technology offering, and so that we can continue to enhance our product mix to improve the ASP resilience. And I think that's where we're marching. And we have a very clear roadmap today that on many fronts of our technology development. So our goal is to further widen the gap in technology offering and increase the revenue contribution from those respective nodes and technology offering, and which we think that we can make sure that our ASP can remain resilient. Yeah.
Great. Thanks, Jason. Very helpful.
Thank you. Next one, Gokul Hariharan, JP Morgan. Go ahead, please.
Hi, Jason and Chitong. Thanks for taking my question. First of all, for the Singapore fab 28 nanometer and 22 nanometer expansion, could you talk a little bit about what is the current pace of the ramp up and the kind of customers that you're ramping up there? Obviously, some of the pricing negotiation that you had back in 22 and 23 obviously had some price escalators. Could you talk a little bit about whether those price escalators still exist, given the environment has definitely changed somewhat? So that's on the 28 nanometer part. Yeah.
Sure. Well, for the 12i, the Singapore facility, given the current market dynamics and customers' alignment, we project the 12i phase 3 production ramp will start in January 2026, and it will ramp up with a higher volume starting in the second half of 2026, and that's the current ramp plan. Many of this ramp schedule and alignment is based on the customer's close communications, and right now, given the application ramp up is going to be mainly in the communication with our 22 nanometer high voltage devices, and we still believe our 22 and 28 nanometer high solution are differentiated from the market, and so the ASP still remain very healthy at this point. Yeah.
Got it. Secondly, on gross margins, so we are roughly in the mid-70s utilization. and we're kind of in the mid to high 20s gross margin. I think depreciation definitely started to grow again and looks like it's going to grow into the next couple of years as you bring in 12i. Could you talk a little bit about what is the kind of the realistic pathway for us to get back to that mid-30s gross margins or low to mid-30s gross margins that we've talked about? Currency is not something that we control, but maybe talk about some of the other factors. Is that kind of like a realistic goal that you're pursuing? And can I think back to some of the previous questions, can pricing be a realistic tool to kind of get there, or is it more challenging to use price as a tool to get there?
Well, absolutely. I mean, it's definitely our mission to continue to improve the gross margin back to the reasonable level. Given the current loading is fluctuating around the 70%, definitely putting some pressure in terms of the gross margin while the depreciation increase. And so the focus is very clear. I kind of answered Charlie earlier that we are focused on technology development, technology offering, even the newer technology offering, and the partnership engagement, and with the product mix improved, and we think that we have a path, going back to the reasonable level. We have, for the past, we have been maintaining our foundry shares in our addressable market segment. Based on our current design pipelines, we anticipate more share gain in 2026, as well as going into 2027, particularly in the 22 and 28 nanometer socket today. Now, while we roll out the other technology offering, we think this will continue to improve, and then we'll definitely march into the direction to go back to the right level of the gross margin level.
Yeah, if I may add on to that, our annual depreciation growth is going to peak out. So if you recall, in year 2023, our depreciation expense increased by more than 20% year over year, and similar magnitude for 2024. And similar magnitude for this year, for 2025. But for 26 and 27, the increased magnitude will be a lot less. Could drop down to single digits. So hopefully we will have a better cost structure moving into year 2026 and 27.
Thank you, Don. Maybe one more question on the high voltage side for 28 and 22. Jason, do we have a pathway below 22 nanometer for high voltage, given there's been some discussion about some of the driver IC related products moving below that, be it to some kind of a FinFET node, but enabling high voltage?
It's definitely on our roadmap today. They are. And while we still believe that 22 high V will be the most compelling and competitive solution today, as well as next couple of years. But yes, the FinFET solution of the high voltage is on our roadmap today. Yes.
And any timeline in terms of when you think customers will start demanding this?
That we're still aligning with our customer, and again, it's contemplating between the value proposition of the 22 versus the next node, and we are closely working on that. And I think I don't have a specific time frame, but I kind of don't want to give it a guess right now, because giving all the data on hand, we still think the 22 nanometer high voltage will have a leg. There will probably be another year to close to 2 years.
Understood. Maybe one last question. Several of the consumer fabless companies are guiding down Q3 quite meaningfully. Your own wafer orders are slightly moving up in Q3. Should we expect that there could be a hiccup in Q4? Like every year seems to be a different seasonality, but just wanted to understand how you think about that inventory cycle for many of the Asian consumer fabless companies, which are your key customers as well?
Sure. I mean, the inventory situation actually is quite healthy, with few major segment already, and auto and industrial, I think they still kind of high, but the rest of it is actually quite healthy. We at this point, given the visibility, we do not guide the Q4 at this time, but our view for the full year 2025 will remain unchanged. And again, I kind of touched that earlier, that we expect our addressable market will grow by the low single digit, and we will still outgrow the addressable market in 2025. And the biggest challenge nowadays is really the visibility. Given the macro uncertainties and the geopolitical concerns, I think the customer is being cautious. It doesn't mean they don't have a demand. The question is they kind of want to play this thing in a different manner. So we're working closely with them, and meanwhile Q2 is growing, Q3 slightly, sequentially, and Q4 we just have to play and see, and we'll definitely report that next quarter. But meanwhile, we think the overall 2025 projection is still unchanged.
Okay. Yeah. Thank you. Thank you.
Thank you. Next question, Sunny Lin, UBS. Go ahead, please.
Thank you very much for taking my questions. So my first question is on 28 nanometer. So if we look at Q2, Jason, what's driving the revenue upside? Is it driven by the 22 nanometer migration, or is it through a product mix upgrade? And then looking ahead, could you share a bit more on your share again in wireless communications and maybe some of the other products going to 2026?
Okay. Well, for the near term, the 22 and 28 revenue contribution increase is mainly coming out from the communication in Q2, computing and communication segment, but mainly on communications in Q2. Going forward, we are highly confident in the continuous growth of 22 and 28 nanometers business in 2025 and beyond, going into 2026. The strong demand outlook is supported by the continued tape-out momentum on many different applications, thanks to our the customers, of course. But again, it's really supported by UMC's differentiated technology and the regional manufacturing footprint as well. This includes our 12i fab in Singapore, which the P3 fab expansion is on track, and we want on track to ramp in 2026. They will begin to contributing the revenue in the second half of 2026, and this will further strengthen our 22 and 28 capacity and support the growth for the growing demand. The combination of the technology proposition, manufacturing quality, and the well-positioned capacity setup will ensure our 22 and 28 will remain the core growth engine for 2020, for the next year, 26. Yeah.
Thank you very much. So on 12i, would you be able to price the wafers a bit higher, give a higher cost structure? And when you talk about high volume production starting from second half of 2026, any type of capacity that we should expect?
Well, I mean, we kind of don't want to quote exactly capacity size, but we are quickly ramping our P3, and we look at this 22 and 28 capacity on a total basis between our own facilities, and I think all the utilization rate across the different facilities on 22 and 28 were above our corporate average. Even today, they are above our corporate average. And the question about I kind of missed your earlier question, the first question.
pricing for Singapore, would you be able to price a bit higher given cost is higher as well?
No matter I missed it. It's a sensitive subject. Well, right now, again, our pricing position is based on our technology offering, our value proposition, and I think that's the baseline of the ASP. In terms of the diversified location, we have to work with our customers to understand the needs, right? So we want them to stay competitive, and we want them to acknowledge the differentiated offering of our technology, and as well as the geolocation benefit. So it's a subject that we will talk about with our customers, but mainly on the technology differentiation as well as their competitiveness.
Got it. Thank you. That's helpful. I have a question on the Intel partnership. Seems like Intel is becoming less proactive in pursuing the foundry ambitions with the new management. So I wonder how does that affect the business development with UMC? And let's say if Intel want to scale down and they look to maybe sell the capacities, in that case, would UMC be interested in acquiring the capacity, assuming the price is reasonable?
Well, first, I think it's hard to comment any speculation, but and I don't want to comment about the partner's priority within their company, but I can only comment about our program. And our current program with them, like I said earlier, the cooperation with Intel is progressing very well, and the milestones remain on track. And the most importantly, the both parties are very committed to this 12 nanometer cooperation. And so I see no change at this point, and we still have very high expectation with this program.
Got it. Thank you very much.
Thank you.
Thank you. As a reminder, please press star key and number 1 on your keypad if you would like to ask the question. Thank you. Next we'll have Laura Chen from Citi. Go ahead, please. I'm sorry, Laura just dropped her line, and we'll take the next one. Jason Zhang, CLSA. Go ahead, please.
Thank you for taking my questions. I just want to follow up the impact from the FX ratio. Can you provide your FX ratios for Q3? Thank you.
So first of all, every 1% move appreciation of NT dollars against US dollars, it will erode our gross margin about 0.4 to 0.5 percentage points. That's where the 3 percentage point erosion come from, on back of the 6% plus NT dollar appreciation against US dollars. And for Q3, we don't do forecast, but we are using current forex rate, which is nearly 29.8 when we give out our guidance. And a reminder for quarter 2, the weighted average was 30.81.
Thank you. My second question is in terms of the competition. It seems like your Chinese competitors now have a better or higher utilization rate currently. So do we see a better market or lower competitions in the mature node? And how can UMC benefit from this lower competition? Thank you.
Well, at this point, more than half of our revenue it comes from specialty technology solutions, which is serve our customer demand in differentiated technologies. For instance, our 2220 AI, kind of touched on earlier, is probably the most competitive solution in a high-end smartphone OLED display market. In addition, our 22 ultra-low leakage and low power technology will deliver another 30 to 50% better power saving compared to standard 28. So we are positioned ourselves as a specialty foundry partner, focused on low leakage, low power logic, embedded high voltage, BCD, embedded non-volatile memory, RFSOI solutions. We want to continue to provide special technology where the percentage of revenue contribution in this space will increase, and the percentage of the revenue contribution competing with the Chinese foundries will continue to decline. I think that's our focus, and I think that we have making quite a bit of progress already, and we think there's more room for us to improve on that.
Got it. Thank you. I have no more questions. Thank you very much.
Thank you. Next one, Laura Chen, Citi. Go ahead, please.
Yeah, thank you very much for having me back. Just a quick follow-up, want to understand your view on the long-term gross margin outlook. We understand that there's a lot of moving parts, rising depreciation and also currencies, etc. But we do see that recently the utilization rate is kind of improving back to high 70%. And as we moving into Q3 with the wafer shipment also going up. So what's our view on our so-called long-term growth margin target? If you can give us more colors on that. Thank you, Jason.
Well, I mean, right now, mid 70% is not great, and so obviously loading will be one of the important focus. And to improve the loading, fundamentally you have to provide competitive solutions to customers. So like I said, we focus on technology differentiation, focus on new technology development, and then following with the key customer partners and engagement. So by doing that, we think the loading will increase, and so as well as the gross margin will get healthier. And the other one is of course the cost, and for the depreciation increase, and Qidong also touched that earlier. This couple of years we have a significant depreciation increase, and after this 2025, I think the increase percentage will start getting more mild. And so while we improve the loading and maintaining the cost structure, and the next thing is of course the ASP management. From the ASP management, and with the more compelling solution, and you have a more diversified manufacturing sites and the manufacturing quality, and we think the ASP will, at least the branded ASP will remain resilient. Not to mention, we'll continue marching forward with our 12 nanometer development, and hopefully that we can continue to improve the product mix as well. So giving all those is putting a roadmap for us to improve our market relevance and position, as well as our financial performance. And for the past, we have already improved our structure profitability in terms of our break-even point, and continue on that front. We already see an effect and benefits. But going forward, there's still work to do, and combining all those, we think we have a roadmap to march into a better result. Yeah.
Sure. Thank you very much. Qidong, can you also remind us what will be the depreciation cost increase for this year or maybe next year?
This year is low 20% year over year.
Yes.
Next year is still a very rough estimate, but as I mentioned, the magnitude of increase will decline significantly, maybe to below 10%.
Okay, thank you very much. My next question is also about our operation in China. As we know, we still have 2 fabs in China. even though there's always very fierce competition, do we see any possibility that our IDM customers, if they want to like entering the Chinese market, they can also leverage our capacity there, thus to be kind of differentiation as well. So can you give us more update on your current strategy in China?
Well, I mean, first of all, we with our diversified manufacturing sites, and we definitely be able to serve different customer needs. And if there is a customer needs for their product to be produced in our China facility, that's something that we very much welcome. Us, the sensing that we have a customer moving from China to other locations, and we very much welcome that. And we believe with the diversified manufacturing offering will give us a benefit of supporting customers with their supply chain resilience needs. Right now, for the IDM customer moving, into the China facility, there's certainly some signals, but I think the signal goes bilateral, multiple different ways. And so we are working closely with different customers, and hopefully we can fulfill their desired needs. Yeah.
Okay, thank you very much.
Thank you. Next one, Tim Schultz, Molander, Redburn. Go ahead, please.
Yeah, hi there. Thank you very much for taking my questions. I had two, please. The first one is on pricing behavior, and particularly just how rivals are behaving in terms of pricing in the communications segment. Is that disciplined pricing, particularly given the steady improvements in days of inventory, or is pricing more challenging? And then I had a follow-up.
Well, when there's ample capacity available, pricing becomes a tactics topic. So not until the capacity becomes tightened, I think the pricing will always be a topic. And I think from a behavior standpoint, is really subject to the capacity situation. So given that the current capacity situation on different regions are different, and I think that conversation still quite often. Yeah.
Okay, that's very helpful. The second one was in terms of the collaboration with Intel. Good to know that the PDK 2026 production 2027 still on track. I had a two-parter there. It's just in terms of the work you're doing with your partner, do you see any impact from the headcount reductions? Does that influence that cooperation in any way? And then the second part, talking about gross margins and the outlook in 27, 28, this journey to get back into the 30s. Obviously, loadings are the most critical factor. But does this cooperation with Intel play a material part in your sort of medium-term gross margin outlook? Many thanks.
From an absolute dollar term, yes, it will. And because the business model that we have, if we coming back to the question about the headcount and the commitment from our partners, is actually quite positive. And I think the program itself is being expanding from the R&D development, now get into the high volume production preparation. So there's a more involvement from different organizations. So I would say, from the involvement standpoint, from the different organizations, it's actually increased. But I can't really comment about their headcount situation, but I can tell you we see a lot more activity from various different departments and organizations, because we're moving from the R&D, the activity gradually start moving into the so-called high volume production preparations. So you can see, while we're expanding the activity scope, there's actually more involved with the program today.
That's super helpful. Many thanks.
Thank you. And now we are taking the last question. Alex Chen, BNP. Go ahead, please.
Thank you for taking my question. I only have one follow-up question regarding to your China business. So, can you comment, in terms of utilization, how is your China fab utilization versus the overall utilization? And in terms of the price pressure, have you seen it eased in recent months, or what is the outlook for the price pressure in China? Thank you.
Well, our China, the 12X facility today is actually running at full capacity, so is above our corporate average. And since that our different sites are mainly serving as the manufacturing facility, the business management is all centralized. So at this point there's no pricing differentiation between different locations for us.
Thank you.
Thank you. Ladies and gentlemen, we thank you for all your questions. That concludes today's Q&A session. I'll turn it over to UMC Head of IR for closing comments.
Thank you for attending this conference today. We appreciate your questions. As always, if you have any additional follow-up questions, please feel free to contact ir@umc.com. Have a good day.
Thank you. And ladies and gentlemen, that concludes our conference for second quarter 2025. Thank you for your participation in UMC's conference. There will be a webcast replay within 2 hours. Please visit www.umc.com under the Investors Events section. You may now disconnect. Thank you again. Goodbye.